When booking a hotel or a flight online, travelers typically pay with a credit card. If they're shopping directly on the hotel or airline's website, that money goes straight to the supplier. But if they choose to book via an online travel agency like Expedia or Agoda, the money transfer process gets a bit complicated. Now, a travel agency has to figure out the safest way to send that money to the supplier, and it seems they prefer one method in particular. Today, virtual credit cards are all the rage in travel B2B payments. In this video, we talk about how they work and their advantages, so keep watching to learn what the future of travel payments holds. In the travel industry, there are many intermediaries operating between a customer and a supplier. For instance, there are travel agencies, where travelers come to search for the best options, and travel management companies that facilitate booking for corporate travelers. And they can handle payments using one of two ways. First is a so-called agency model. Here, an OTA or a TMC doesn't collect or process payments on their own. Instead, when making a purchase, a traveler's card information is passed to a supplier that takes the payment directly from the consumer. Since payment processing is a complex and highly regulated field, OTAs choose not to do it. The agency approach saves costs and reduces credit risk involved in processing pay-ins, not to mention there's no need for integration with payment gateways. This, of course, means that they have no control over the payment methods offered to the customer, get no access to payment analytics, and often can't obtain the commission for the services before the supplier pays them back. For customers, this is also inconvenient. Imagine if a cashier at the supermarket checkout took the shopper's card and passed it to the manufacturer that accepts the payment for the milk they've picked up. This would be confusing, to say the least, and if they've bought a few different things, their payment details would be passed to even more suppliers. So, many intermediaries prefer a different model, one that makes them a merchant of record. Being a merchant of record, an OTA or a TMC is the one who collects customer payments, authorizes the transactions, and then pays the suppliers while retaining the commission. Here, a travel agency can shape the customer's payment experience as they see fit by, for instance, offering different payment options, like the now popular buy now, pay later model. But this places on their shoulders the issues of data protection and all the complexities associated with paying suppliers back. So how do they do that?
Historically, airlines have accepted payments from travel agencies through the IATA clearing system or through the ARC clearing system in the US.
This is Paul Van Alphen, travel payment strategist from Up in the Air, who will help us unravel this topic today.
And that was predominantly done by what's called B2B cash, so basically getting billed by the clearinghouse for the total sum of, the agencies get billed for the total sum of tickets issued for all the airlines in a particular country, or the travel agency would put the customer's card number in the booking so that the airline could actually charge the card. But those are typically then consumer cards or corporate cards.
So using a legacy clearinghouse like ARC or BSP is not ideal because of how long settlement and reconciliation can take and how susceptible they can be to fraud. Consequently, a different form of B2B payments has been gaining popularity. It uses virtual credit cards. A virtual credit card, or a VCC, is a payment option linked to a real card account that can be issued for a certain amount of money to be paid to a particular recipient. Basically, for every transaction, a single-use virtual card is generated with a unique 16-digit number and expiry date. It provides an unmatched level of simplicity, security, and control since the restricted amount of money can be spent only for a specific purchase or to a specific supplier within a limited time frame. Virtual credit cards go back to the 1990s, and they've become quite common in the B2B payment sphere, specifically for OTAs and travel management companies. In 2021, the global value of virtual card transactions was $1.9 trillion, and it's expected to reach $6.8 trillion in 2026.
what travel agencies have started doing more and more over the last 5 to 10 years is actually moving away from the agency model and becoming a merchant themselves and taking the pay-in from the consumer in a different form of payment, in a different currency, for a different amount, and then in a second step actually insert a virtual card number in the booking and then submit that to the airline for processing.
Virtual credit cards overcome many limitations of other payment methods and provide benefits both to agencies working as merchants of record and to their suppliers. Basically, they have the same benefits of plastic credit cards, and they're supported by the same technology.
For the merchant, the value of credit card is undeniable. Everybody knows it. Everyone's been using it. It's an incredible system. Perhaps we would like to see more variety in there, but it exists. It's possible to make a transaction at 1 o'clock at night, 1,000 miles away, with high degree of certainty that you're going to get what you paid for.
And this is Spencer Hanlon, a head of travel payments at global payments platform Neum. So why exactly are virtual credit cards so popular in the travel industry? First, let's discuss a scenario in which virtual credit cards are used. Say Barbara is booking a trip to Los Angeles via a travel agency, and her itinerary must include a plane ticket, a hotel stay, and a car rental. After entering her credit card data on the agency's website, the agency authorizes the payment with its bank, which charges Barbara's card, including the OTA's markup. Then, the agency initiates virtual credit card issuance with their virtual card provider sending the details on the restricted amount of money that each element of her trip costs. A virtual card provider returns 3 virtual credit cards, which consist of a 16-digit card number, a CVC code, and an expiration date. The agency then sends those virtual cards to the airline, the hotel, and the car rental provider, who either charge it instantly or after checkout, depending on their agreements with the agency. Once the transaction is completed, the cards expire. But how is this process beneficial? First, it reduces the risk of fraud. By some estimates, virtual cards are safer than normal credit cards, which use the same identifying names and numbers on many transactions for years, and were, unsurprisingly, the second most vulnerable payment method in 2022. As the travel provider never accesses a travel's payment details, they can't overcharge a person or charge them for something else before or after the transaction's been completed. But basically, since virtual cards operate on a closed loop, there's no fraud to expect. Second, virtual cards are easy to implement. Communication between an agency and a virtual card provider happens via API, technology that enables data transmission between 2 software programs, which is extremely common in travel. This connection can be established on top of existing OTA or corporate booking software and doesn't require change to internal processes. Also, on the acquirer side, there's no need to build new infrastructure as virtual cards act just as regular credit cards. Plus, any number of virtual cards can be instantly generated.
So that means that more and more travel agencies become the merchant. They can take a wallet, a open banking payment, a local card that cannot be supported by BSP. They can do that in different currency. They can create kind of like a basket where they combine different products into one checkout, and then in the background pay the individual suppliers in whatever form of payment they have agreed with them. So they have full flexibility. They can completely automate the process. They can balance cash flow and cost and for instance fraud risk.
The third benefit is the VCC's ability to overcome dramatic currency changes, which is particularly important in the travel industry with multi-currency transactions being the norm.
Only last year, we saw the situation in South Africa where the currency was depreciating very fast. And the billing cycles in some of these clearing houses can be a week or 2 weeks, or in the extreme time, a month. It's rare now, but mostly a week or 2 weeks. You can see a dramatic change in what you thought you'd collected in local currency in terms of its US dollar value per se, to what you now have 2 weeks later. And so the ability to get paid and have that final value and transaction amount confirmed is a unique advantage.
Also, virtual credit cards aid in booking cancellations. In the travel industry, people are often buying services that won't be delivered for months in advance, and a lot of unforeseen events could happen in that time.
This advanced purchase thing means that you need the ability to get your money back should things change. And that's the beauty of the credit card scheme, is that flow comes a lot easier. It would be a lot harder if the money had to flow through banking systems when the foreign exchange rate may have changed dramatically, the banking relationship between the merchant that you first set out with is no longer there, et cetera, et cetera. Getting your money back through multi-jurisdictions, relying on the old rails, after a long time has passed, is a lot harder than relying on the credit card schemes.
Another benefit is control and process automation. Virtual cards are created to be charged by specific vendors for specific transactions. All purchases made using them are saved in the corporate travel system, so it's easy to track and analyze spending. They also simplify reconciliation for OTAs, since each transaction is associated with a unique virtual card number.
This is a very large-scale business doing hundreds of thousands of transactions a minute globally, and reconciling all of that with a unique number, which is the virtual credit card number, is dramatically easier. And what you can then do is put the workload so that machines can talk to machines and solve the problem.
Finally, virtual credit cards are created for compliance. They are single use, so you never store or share actual consumer card data to pass to suppliers, which will alleviate some PCI DSS compliance efforts. Although there are many virtual card benefits, their adoption is hindered among some suppliers. Why? Consider interchange fees. Unlike OTAs that earn rebates for each card issued, suppliers are the ones paying interchange fees for processing VCCs. VCC fees are higher for suppliers than fees paid for using traditional payment channels. For instance, in the EU, interchange fees for processing corporate virtual cards, unlike consumer cards, aren't capped. Card issuing banks can change as much as they see fit to cover related expenses. So, regardless of the many benefits of virtual cards, airlines, for example, prefer working with ARC and BSP to avoid higher costs.
The key part here is also knowledge and awareness that it's not only about direct cost. There's many more aspects that play a role. If it's the additional sales that the airline will generate, if it's the reduced risk that they will see for fraud, for instance, because that's completely with a travel agency, if it's the cash flow that will speed up.
While many OTAs already have the resource to handle VCC payments, the lack of awareness is another challenge.
We need people in the travel industry that have the understanding of payments. We have thousands of people who have the understanding of rich leisure or business travel propositions, but payments is not a ubiquity in terms of knowledge. And that's where I really truly believe we're only scraping the surface in helping these very exciting businesses optimize their business in terms of payments.
Today, virtual card technology powers B2B payments for the biggest OTAs, such as Booking.com, Expedia, and Agoda. To join them, simply partner with a VCC provider and integrate VCC payments into your system. A more difficult step would be to address the unwillingness of suppliers to accept virtual cards. So, just like those big players, you will still need to provide a few payout methods before more suppliers adopt VCCs.
Regardless of whether people like it or don't like it, I do feel that the cork is out of the bottle on this model, and it is only going to accelerate. I have no doubt at all that the days of BSP and the days of ARC are, frankly, going to be diminishing over time, and the proportion of B2B spend is moving on to credit card rails.
We will keep exploring payments in the travel industry. If you want to learn more, check our videos on PCI DSS compliance and the buy now, pay later trend. See you next time.